All right, everyone, welcome back to another roundup edition of On the Margin. Today, I'm joined, as always, by my youthful co-host, Mr. Mark Yusko. And it's youthful because he is the one down at Bitcoin Miami, and I'm the one being an old fart up here in New York.
There you go. There you go. I'm down here hanging out with the kids. And, obviously I had to dress the part. So I got the Bitcoin orange pants on today. And I do have the on-chain monkey sock game. So... and it's because Danny Yang, the founder of MetaGood, is down here. They had an Ordinals conference yesterday, which is pretty big deal.
No kidding.
A whole conference dedicated to Ordinals. And he inscribed the whole 10,000 OCM collection on to a single inscription using like only 200K of space. So it was pretty amazing technological feat. And he was down giving a talk about that. So shout out to the OCM crew.
So what is the sort of Bitcoin Orthodox thinking on ordinals these days?
I sort of it depends who you talk to.
Yeah, because my read in the beginning, right, there were a couple of the sort of thought leaders that came out and said, hey, this is not necessarily good. Maybe we should censor these sort of non-legitimate transactions. But now I feel like there's been a little bit of a rebirth around the Bitcoin block space talk. So I'd just be curious, what do people think?
Look, it seems silly to me to argue against one of the primary purposes of a blockchain is to be a secure, safe store of value, right? Transactions, ownership of an item. In fact, you think about it, the very first thing on the Bitcoin blockchain is an image. Right? It's an image of the, chancellor bailing out the banks, or the exchequer bailing out the banks for the second time. Issue of the FT, not the FT, whatever, the London Times.
Yeah.
But so I think there are a lot of people that are like, it's perverting the original intention of a peer-to-peer, cash network because transaction fees are going up. Like, let's think about this, y'all. Why are transaction fees going up? Demand. Demand's rising, supply is fixed, so transaction fees go up. Okay, so that means, that means you can't transfer a few sats for as cheaply as you could. But that's not the primary use case for the Bitcoin blockchain. It's not going to be where you and I exchange sats to go get ice cream. It may be the ultimate settlement layer for all of those transactions, but there's going to be something else on top if we want it to be money in terms of transactional. Same way Visa batches transactions and then settles to Fedwire on a periodic basis. So I think it faded a little bit. But, look, a maxi, true maxi, like someone who really believes that the only thing Bitcoin is good for is to hold it in your hands really hard and maybe put it on a thumb drive and then you bury it in your backyard. You're not going to convince them that anything else other than that is good. I don't understand those people. I really don't. We've talked about this before. If that's what people think Bitcoin is, then we can all just go find another job because that's gold. We don't need to reinvent, something that just sits idle and does nothing. But to have a blockchain, which is a ledger, a public ledger that is super, super secure, right? We'll all probably agree, I think, that the Bitcoin blockchain is the most secure blockchain, is the most secure network. Why wouldn't we want that to hold the highest value assets, titles, identities? Seems like the logical use case to me.
Yeah, I find it pretty interesting. I do think there's something a little bit oxymoronic, or it kind of brings up a pretty interesting debate about permissionless. Bitcoin is sort of the original app chain, right? It has a very specific feature. It wants to be money. That's an application.
Yeah.
But it's also open and permissionless. And if you think about that for a couple of seconds, it's like, well, how can I want it to be this one specific thing, but also have it be permissionless and anyone can build anything on it? And this has been manifested around, I guess this is a very old debate around opcodes and the sort of data that you can inscribe on Bitcoin for those of you who like didn't follow this whole debate, there was a big upgrade a couple of years ago called Taproot, and that basically relaxed a certain type of data that you could the restrictions around data that you can inscribe on a blockchain. Ordinal theory was kind of this new and inventive way to inscribe more arbitrary data on the Bitcoin blockchain. And for the reason I like this is, first of all, look, I kind of like the idea of Bitcoin as the sovereign store of value, kind of only financial transactions. I can see that appeal. I get it. But I also am of the belief, generally, let the market do what it wants to do and don't rely on sort of central planning. And so I like that. And then the other thing is, for those of you who aren't like in the weeds of how Bitcoin functions, there are two ways that miners get paid. Miners are the ones that secure the network, right? They post up the collateral in the form of machines and electricity. They have two ways they get paid. One is a block subsidy, and that's the inflation schedule of Bitcoin. The network emits a certain number of Bitcoins to reward miners for the work they do. That's gradually going down and going away. The other thing that they get is transaction fees, and that's actually fees for including or ordering or whatever transactions. And that, the problem for Bitcoin for a long time has been the vast majority of how miners get paid is this block subsidy. Yeah, when that goes away, people are saying, hey, this is in trouble. You guys are in trouble. Like the transactions
incent the miners.
Yeah, and how you got to incent the miners. And now you can actually see post BRC20, which is this new standard, it's, the transaction fees, I think for the first time ever, went above the block subsidy.
Yep.
So this could be a solution to Bitcoin's eventual security problem. And it's just kind of cool. Are you really going to hate on people inscribing wizards? I just,
again, it's what people are haters are going to hate, right? That's just life. Haters are going to hate. And no matter what you say or what you do, they're just going to hate. And that's fine, right? I have no time actually for those people. I got lots of time for creators, innovators, people who are trying to move the whole community forward. And so I love people like Danny Yang, who said, okay, I understand. There's some concerns about the size of an inscription. So don't be inefficient in how you do this. And they found a way to, inscribe an entire 10,000 PFP collection into a couple hundred K. That's awesome. So
yeah, it's the one thing I will say that makes this a little bit, let's call it politically tricky, is this Taproot upgrade sort of subsidized this one specific set of data called witness data. And that's where ordinals are being inscribed. So actually, in a funny way, these NFT sort of arbitrary data inscriptions are generating way less fees. Essentially, the network is subsidizing them. And that, you could make a pretty strong argument that that's not what the Bitcoin blockchain wants. However, another value of the Bitcoin blockchain is once it makes its way into the code, very difficult to change. You need some sort of fork to change those rules.
Well, but that goes to your point about the free markets, Michael. That, Taproot happened. We all embraced, well, not all, like there were fights about that. Should this happen? Should it not happen? But your point, once it happens, okay, that exists. The fact that somebody innovated around Ordinals protocol and BRC20, that's the nature of innovation. Yeah. People take opportunities. And would I like to pay less or more, generally speaking, for a service? Less is better. Now, I'll pay more if I get good service or good, but if I have a choice, I'm going to pay less. And there are a lot of examples in this world where a system subsidizes different elements, right? And so, but I think it's a great point. Great point.
Yeah. Eventually, I don't want to get too. I've got some more macro questions for you here, but eventually, I do think, especially on layer one blockchains that are supposed to be credibly neutral, the Bitcoins, the Ethereums, probably eventually the Solanas of the world, then I think what you're going to see is when you start to tinker with incentives, there's going to be an enormous political element attached to that. A great example of this is in Ethereum, these sort of data blobs where you're making call data for rollups cheaper. And that's good. Everyone agrees with that, right? That's the on the roadmap for how Ethereum is going to scale. But really what that is it's a subsidy. And it's, there are going to be political fights about that. It'll be fun to watch in the future.
There will always be fights. Look, and that's the perfect segue. Politics, geopolitics, macro. Could we have uh, I won't say a crazier time. We've had crazy times in the past, but um, man, I am struggling with the geopolitics of what's going on. And we had this amazing webinar yesterday.
Yeah.
We had one of our China team got one of our managers that focuses on and only invests in the semiconductor space in
Yes.
China and Taiwan. Um, and he just did a masterclass on how the semiconductor industry is changing and what the real issue is between China and Taiwan and the US. And it was absolutely fascinating. I mean, and at the end of the day, he was very circumspect about it. And he's like, um, you know, the growth in any market, whatever that market is gonna, to your point, is gonna drive the innovation. And China is growing really fast on a relative
Yes.
basis compared to every place else. And they have said, okay, I cede the high end level integrated circuit design functionality to y'all in the US and the Netherlands, right? You're the best at that. We're not going to try to replicate that. But in terms of the manufacture of the lower end actual circuits themselves, the chips, yeah, we're going to win because we have better production capabilities. We are the manufacturing engine of the world. And despite all the rhetoric and the tariffs and the exports out of China to the rest of the world continue to move up exponentially. And they win. They just win. And
Yeah.
so all this nonsense about, oh, we're gonna ban all these companies, we're gonna blacklist these companies, like they don't care. In some
Yeah.
ways, it's like I posted that, you know, Bitcoin actually doesn't care if Gary Gensler tries to ban it.
Yeah.
And not he, she, but the entity just doesn't care. It's
Wow.
going to continue to do what it does in a decentralized way. And in the same way in the semiconductor space, China's going to do what they do best, and that's make stuff. So,
Yeah.
which is very
So
interesting.
yeah, I'm also, so I sort of view this great power competition as this black hole which is pulling almost everyone and everything into it and shaping a lot of worldviews, and it's driving.
Mhm.
It's like there are two bipartisan issues in United States politically: spend more money, and we don't like China. And that is like that's the
Exactly.
two things that everyone agrees on, and people really view things through this lens of like competition with China, but. Let's
Yeah.
talk about rate markets here for a second. So I would love to get your thoughts on, I think, so if you're following along visually here, you can see that basically what the market thinks, the implied rate policy basically turns post June of this year, and we start to descend into cut territory, which was really just ramps up through January of 2024. So Mark, do you roughly agree with this? And maybe we could get into, there are a couple, Stan Druckenmiller gave a great interview. I think I referenced it on our roundup, but Paul Tudor Jones spoke this week as well and gave an interview. And those guys are legends, 100%, some of the smartest guys to ever do it. I do want to caveat and say, like, sometimes there might be, ulterior motives for getting on and speak on CNBC as well, but I always listen when those guys
Of
talk. I
course.
just love to hear what they have to say. And Paul Tudor Jones gave this interview where he mentioned that we're near the end of this hiking cycle, and he sees stocks ending higher this year. So with all that as a lead in, what do you think about this projection?
Uh, I think the projection is aggressive, um, but it's always aggressive, right? If you go back and you look at this projection for rate hikes, it was always aggressive. Um, the market, I don't know, and I think people are overconfident in their ability to forecast, particularly
Yeah.
forecast the activities of other people, where you really don't have any control. And so I think that's part of it. So if you go back and you look at just about any chart on rates over time, whether it's the the Fed themselves with their dot plot and what they said they were going to do with policy, which was always way more aggressive than what actually happened because timing was different, or the futures market kind of discounting. I will say the futures market is more accurate than the participants. Pundits at the different investment banks are usually really bad. I said the Fed themselves have been really bad. I think these markets, these implied rates are actually more accurate. I struggle with the aggressiveness of cuts given no declaration of slowdown or recession, no give on analysts forecasting higher profits. I mean, someone came out yesterday, it was like, AI is gonna, increase S&P profits. I think they said like 30%. Like, on what planet is AI? And we've all seen the meme, I'm sure, of the, handing the CEO his talking points. Say, we're integrating AI. We're integrating AI. No matter what business you are, you can be Dairy Queen. We're integrating AI. We're going to mix your upside down, milkshake. I think I can't remember what it's called.
The Blizzard.
Blizzard. Yeah, we're gonna mix your Blizzard with AI. I mean, are you joking? So if you're the rate setting and things are good, right? Things are good, meaning we're expanding, profits are doing well, companies doing well, households are good. How do you cut interest rates? Why do you cut interest rates? That's not the normal reaction when things are good. When do you normally cut interest rates? When things are tough and you're trying to re-stimulate an economy. And the other thing I don't really understand how they're going to walk this tightrope is the budget and the deficit. We're still talking trillions with a T, back to your, the thing that they definitely agree on. We need to spend more money. We especially need to spend more money for the people in my district, right? Whatever if I live, if I'm in Maryland, we need to spend more money on fishing boats, crabbing boats. If I'm in California, we need to spend more money on stopping wildfires. I mean, whatever it is, spending money is there, and someone's got to buy those bonds. That, I think, is not an environment for aggressive rate cutting. I just don't see it.
Hey everyone, we'll get back to the show in a minute, but just wanted to let you know that we've got our Permissionless conference coming up. This is the one that we do with Bankless. It is the biggest and best conference in DeFi. It's going to be in Austin, Texas this year, September 11th through the 13th. If you've been in crypto for a while, you know that bear market conferences are the best conferences because those are the ones that all the alpha's at. This year, we've got a phenomenal lineup of speakers, and the topics that we're covering are insane. We're going to be talking about ZK tech, roll-ups, account abstraction, MEV, app change, the whole suite of stuff. I cannot wait myself. So, because you're a listener of this podcast, you're also going to get a discount. Type in PODS20 and you're going to get 20% off your ticket. Click the link at the bottom of this episode and go get it now because prices go up every 2 weeks. Yeah. I'm sort of in your camp here. I think there's the old chestnut, right? That the bond market is always right. The bond market doesn't have such a hot track record these last 18 months. And I think this is probably because we're at this weird transition point where we've got inflation, real inflation for the first time in 40 years. And there's not a lot of living memory of that, right? Most of the people who are probably operating in financial markets today, they haven't seen an environment like this, at least not in the United States. So I think it's just kind of throwing everyone for a loop in terms of expectation. Probably a strong dose of hopium that's added to that cocktail as well.
The hopium's crazy. No, Michael, all of the gain, like all of it, this year in equities is multiple expansion on declining earnings. Right? Literally, earnings are going down and multiples are expanding. Yeah. And I think 50+% of the gain is 5 or 6 stocks in the Fang Man. And, Netflix was up 10% yesterday. I mean, 10%. So 2 days ago, if people listen to this on Saturday, but 10% on what? On an announcement that the growth of their lower price ad supported business was going fast. So I'm like, so the cannibalization of your high margin business is going faster than you thought, and somehow that was good.
Yeah. I Netflix, I was one of the first stocks I ever bought. I'm not sure if I've told you that, but yeah,
Nice.
I got it in 2016 or 2017. I think $140 was my cost base, and I wrote it. And the whole thesis at the time was very simple. It was right around the time that they were starting to expand internationally. And I was just thinking, there's a gigantic market out there, as one does. And it did. And Netflix, for a little while, if you held it, or if you paid attention to it, didn't, during these earnings reviews, they'd always talk about the revenue and the EBITDA, but really it was the subscription number. And really it was the international subscription number. And they just clobbered expectations for 3 or 4 years. It was every single quarter, it was a beat, and the stock would rip 10 or 15%. On top of that, every once in a while, they would jack the price up by, $1, which was about 10%. And stock would go 15%, sometimes. And then I kind of just woke up and looked at the number of subscribers they had, 200 million. And I view it more on a household basis, because households subscribe to Netflix, not really individuals.
Yeah.
Man, that's got to be close to saturating the market. And then they announced that they were going to do video games, and I sold the stock. I was like, they might execute on that, but I think their growth engine has run out.
Listen to these numbers, right? In second quarter of last year, they did $8 billion in revenue. Okay. And they actually made a little money. They made $1.5 billion. Okay, it's pretty good. Third quarter, a little less than $8 billion of revenue. So it went down. Didn't go up, went down. And they made about the same amount of money, a little less. Then fourth quarter last year, went down again, $7.8 billion. And they didn't make any money. So they went from making $1.5 billion to not making any money, because they had to, subsidize through ad spending, I guess. And, that's one of these games things, right? Where they give the stuff away for free. You get a bunch of subscribers who then cancel after 4 months, but they get to count them as subscribers. So I don't know. Why would anyone pay? Let me get their multiple. Why would you pay 40 times, 40 times earnings for a company whose revenues aren't growing? They're flat to declining. We live in the upside down, because I could go through 100 big stocks that are acting this way, as they're becoming viewed as a safe haven at any price. And look, Howard Marks has a line that I repeat all the time. I repeat a lot of his lines all the time, but one of his lines that I love is, look, there's no investment good enough that you can't screw up by paying too high a price.
Yeah.
Not one, right? There's no business good enough that you can't mess up by just paying too much. And I think that's where we are. We're back to and here's the crazy thing. Interest rates are higher today than they were 3 months ago, 6 months ago, 9 months ago. Correct? Right? I'm pretty sure that's a 100% accurate statement. So if your discount rate's rising, why would you pay a higher multiple? It's nonsensical.
It kind of is nonsensical. And maybe one thing look, markets move at a rate that is different from the rate of human perception. As in, sometimes we can spot a trend and it just takes it takes longer to get there, and you're confused and hemming and hawing and why is this happening? So I think, I'm sort of in the camp with you, and I'm looking at this and thinking, I don't think at least traditional markets haven't taken their medicine. So one explanation for what we're describing here is Netflix did, it was a bloodbath in 2022. I mean, as bad as it was for
Yeah.
crypto,
Yeah.
the big tech giants, I mean,
Yeah.
their
Yep.
stock fell out of the sky. If you remember,
Yep.
Bill Ackman bought it. He had to turn around right and sell it. It was a bad year. So
Yeah.
there's some amount of mean reversion that happens after a stock goes down, whatever it did. I don't have the numbers, but it's
Sure.
a
No, no,
60%.
no. No, it's a great point. Meta is a great example, right? I
Yeah,
mean, went
mean
down
reversion.
50+%. Um, and look, part of the problem is we still have this massive passive, so not alliteration, but
Uh,
okay, funny, massive passive uh, world where every 2 weeks, money from people's 401ks and 403bs goes into these S&P 500 index funds, and it doesn't get to think about valuations. It doesn't get to think about is this a good business or a bad business at this point. It just has to buy them based
yeah,
on their capitalization weighting. And this is probably the scariest stat I've seen. And I don't really know how to deal with it other than just not participate, is the weighting of Apple plus Microsoft, which are two great companies. I mean, they're great companies. But the weighting of those two is now over 14%
well,
of the US stock market. I can't think of a time in history where that level of concentration has led to positive returns over a meaningful time frame. Now, people would, oh, but the last 2 years has been great. Fine. You know what? Yeah, because we've lived in the upside down of this transition from the nirvana of zero interest rates, and therefore everything is worth infinity, right? Because if I divide anything by zero, it's infinity. So okay. To well, I mean, everything that I look at, whether it's credit card delinquencies spiking, whether it's travel activity falling
uh,
off, whether it's home ownership collapsing, home buying, home transactions collapsing, shows that there's been real impact on the average person of this spike in inflation, as you described. And yet, a certain number of businesses can still paint a picture of, oh, we're making a lot of money. Well, yes, everyone's renewing their subscription to 365, Office 365 or whatever. Okay. And they said they're going to introduce this AI thing into Microsoft. I don't know. I haven't heard very much really good about it from the people who are using it. I tried Bing once, didn't do
yeah,
anything for me. So, they invested 10 billion. I think we talked about this. They invested 10 billion in OpenAI, but their market cap went up half a trillion.
uh,
Are they going to make $500 billion on Bing? I'm gonna call no. I'm gonna say no.
yeah. I mean, this is also, it's just, this is what happens when markets overreact to new technologies that are super interesting, right? We talked about this with Chegg. That was sort of the first. I'm sure there are others too. AI is going to pop up in earnings calls the same way blockchain used to pop up in earnings
Oh,
calls.
the spike was crazy. I mean, it was
Yeah.
absolutely crazy.
The market will overreact to winners and losers, assume things are going to happen in 2 years. Nothing's going to happen in 2 years. Those prices will revert, and then there will be a slow, steady grind in that direction.
Oh, did you see C3 AI? Do you know
Mm-mm.
this company?
No.
So there's a company called C3 AI, and they were called
Yeah.
C3 AI before AI, because that's the other thing. AI is not new.
Yeah.
1950
Yeah.
was when the term was kind of coined and coming to the lexicon. So 53 years been working on AI. But this company, and I don't know if they're based in North Carolina, but they advertise a lot in North Carolina. And so the airport, you have these big signs all over, C3 AI. The stock was just going down because they don't make any money. Like, they lose boatloads of money. But when the AI thing hit, when ChatGPT came out, this stock went up. I mean, I should look at the number. It was nuts. It was crazy.
Yeah. Yeah.
And then people are like, well, what do they do? They're a consulting firm. And it reminds me of what happened. There was this company back in the dot-com boom. And what they did, they were a little consulting company, and they helped companies change their name to .com.
And
And we actually invested in this company, believe it or not. And our cost basis was 50 cents. 50 cents. It went public at $100.
yeah.
Okay. 200 times. And I remember calling the venture capitalists we invested with. And I said, what should we do? We got the stock back distributed. He says, I'm an insider. I'm a board member. I really can't talk about it, but I can say two things. Okay. Revenue, 6 million. Market cap, 6 billion. Like, oh, I gotta go. I gotta sell. And we sold. And the stock went to 4. Now, at 4, it still would have been an 8-bagger. Still would have been a good investment. But that the hype, I mean, can you believe that hype? Or we can go Long Island Ice or Long Island Iced Tea, Long Island Blockchain.
Yeah.
And,
But there's the signal in that, and I think,
Oh my
I really think, look, I know maybe for some folks on this who are listening, they're going to think this is silly, but I used to just look at that and say, that's a bubble. Man, these crazy people, what are they thinking? Yada, yada. A fool assumed part of it was money. Now, I sort of still think that, but I do think bubbles are indicative. They tend to actually be directionally right. Things that inspire that much euphoria and enthusiasm generally are actually directionally right. They're just wrong on the timing. And I think
great
that's
insight.
the tricky thing.
That's a great insight. Yep.
It's, you see it in crypto cycle after cycle. And there is this, if you're sort of deep in the weeds on crypto, I do think one smaller trend that tends to be true is the sort of hypiest part of a bull market that everyone just fades and says that was ridiculous, ends up getting reworked and ends up being the driver for the next bull market. Best example I can think about that is ICOs. I mean, ICOs, everyone was like, you wrote it off. Token was a dirty word for a while. Then they rejiggered that sort of capital raising mechanism, and it drove the next cycle. But I want to just like put on our speculation caps for a second here and ask you.
My favorite.
We might have talked about this last week, but I was talking to some friends about this, and I have some more opinions on it. But there was this great quote that resonated with me, just having worked in crypto for a number of years now, which is Stan Druckenmiller talks about. I'm paraphrasing, but basically, when you make interest rates 0%, people do stupid things. When you hold them at 0% for 11 years, people do really stupid things.
Really stupid.
And I am in the camp that I don't think we've seen people take their medicine yet. And I'm sort of wondering, okay, so we know that there's stress in the banking sector, but we also know post 2008, there was a lot of regulation that basically moved risk taking that banks wanted to do out into kind of this broader shadow banking sector, alternative lending and financing centers. And for me, that's the part where I just feel like it's natural to think that's where the next bit of stress is going to come from. But I don't know exactly where. Commercial real estate is the obvious one.
Yeah.
But the fact that everyone thinks that it's going to be commercial real estate makes me think it's probably going to be something else. Have you thought at all about it? If you want to speculate,
Again,
where do you think it's going to come from?
It's the right analysis. It's that second order thinking, right? I mean, maybe one of the most important things, that is the most important thing in investing is second order and third order thinking, right? If you just think about the headline or the primary trend, it's already in the price. I mean, that's what everybody already knows. It's that ability to do the second order thinking. Like, okay, we had stress in banks in the global financial crisis, and the response was very draconian legislation. You shed that entire unit. You can't do that anymore. We're going to separate this iBanking and banking. And okay, did iBanking stop happening? No. Where did it go? Where did prop trading go? You can't prop trade at Goldman Sachs anymore. Well, in theory, Goldman still prop trades, by the way, because they get an exemption, I guess. But so does JP Morgan. But Okay, the rules apply to everybody else except them. But it had to go somewhere. People are still speculating. People are still proprietary trading, and they're using leverage. Where did it go? Okay, well, let's think about where did it go. Or your point on real estate. Okay, people are still buying real estate on leverage. So where did they get the loans? Well, let's look at that. Well, one place you have actually seen it where it's like everybody knows, well, commercial real estate's got to be getting whacked. I mean, 350 California selling for 70% off. That's got to get reflected somewhere. REITs, commercial, office REITs, eviscerated. Okay. Well, where else? The non-bank lenders, peer-to-peer lenders and like eviscerated. Okay. But where else? Offshore banking kind of sectors. People, maybe went and got something from Deutsche Bank or Credit Suisse, gone. So I think there has been damage in these places that kind of said, well, you can't do prop trading at Goldman Sachs anymore, but we're a Swiss bank. You can do that here. And, when Trump was president, before he was president, where did he get his big loans from? Deutsche Bank. Yeah. So, look at Deutsche Bank's balance sheet, look at their stock price, hadn't been very good. So but I do think that second derivative thinking is really, really important. And just look at these second tier regional banks.
Okay.
Wow. I mean, pounded. But I saw somebody tweet yesterday, oh, KRE just made a bottom, the banking index.
Yeah, I saw that.
And okay. I mean, you could declare that it made a bottom because it stopped going down. And maybe it has, but have the banks that made the loans on office buildings like the one that I'm in, which is basically empty. I mean, literally. And, my team doesn't come in the office anymore. The guys downstairs don't come in the office anymore. At some point, we're all just going to say, we don't need this space anymore. That isn't in the price of those local community banks. So I do see that rolling down. I guess what could save this cycle? The return of free money. So, if bad capital allocation caused the really stupid things, and now it's time to pay the piper, we don't have any money to pay the piper. So what do? Well, I guess we can suspend disbelief again and go back to, bad capital allocation world of low interest rates. And in that environment, and it's funny, I think that's where this reversion of liquidity, they actually have been sucking liquidity out of the system. Now, it's slowed down and reversed pretty hard with the bailout of the banks. It wasn't QE, but it theoretically it has to get paid back, but we'll see. But the balance sheet went down, then it spiked back up, and now it went down a little bit more. So they're not putting liquidity back into the system. Should they turn around and lower rates, that liquidity will certainly, revert back. And in that environment, it could be a really big risk on kind of, Paul could be right. We could get back to Looney Tune land or Sillyville or Silly Town or whatever I used to call it. I don't remember.
Yeah. I don't know. I sort of have, I feel like I maybe in past times would have a prediction here, but I think it's just so complicated and so hard. I could kind of see it going either way, right? I have this mental framework that really dominates my way of thinking about this, which is just the amount of outstanding debt that the U.S. has. First of all, debt, when debt growth outstrips GDP growth. Something has to change over a period of time. And you've talked about this at length. Many of you listening to the show will have kind of heard the different options, but to me, the one that I think is most likely is a soft default in the way of inflation. Basically,
Yeah.
that's what I think.
Yeah.
And I think that inflation ends up running hotter than interest rates. I don't know. At some sort of sustained period, there are probably ebbs and flows as to what that ratio looks like over the coming years. But I generally think that. So that's my sort of thesis for. But I don't know how specific
Well, no,
asset
but
prices are going to
your
react.
insights, your instinct is right. I mean, for 100+ years, the rate of inflation was roughly equal to, not roughly, it was exactly equal to the short-term interest rate, the risk-free
Yeah,
rate, right?
yeah,
So your real return for leaving your money in cash was zero,
uh-huh.
right? And that made sense. Well, we went through a whole period where it was less than that. Math says we now have to have a period where that's reversed, which is what we have. You know, today we have, still, at least right now, a positive spread, and it's shrinking, right? I mean, the CPI number come down, and interest rates kept going up. Now they're almost back to that neutral level. But if you're going to cut rates and that inflation doesn't recede, then you're going to have to. And if you think about a 10% average return, right? I think the long-term return on stocks is 10.5% compounded over long periods of time. Let's just round it to 10 for evenness. And you have a decade like we had because of QE, where you compounded at 15. You have to, by definition, have a decade where you compound at 5. Unless you're going to tell me that the 140-year trend of 10.5 is somehow going to change. It's not, right? I mean, 140-year trend exists because it's a 140-year trend. And when you look at the regression line, I mean, it's beautiful. It's perfect because there's a logic to why you get a 10.5% return, right? There are components to it. You have the risk-free rate that said long-term is averaged about 4%. That just has been the risk-free rate for 100+ years. So 4%. Then you get the credit premium, right? If you're a business, there's a 2% advantage by taking credit risk as an investor, right? Because you might not get paid back. With the government, you're pretty sure you're going to get paid back. So that takes you to 6. And then there's another kind of 4.5%, 5% for equity risk. Well, what's equity risk? Well, equity risk is the risk that there's no there after you pay the bondholders back. And then the other way to think about it is if I hold an equity, I get paid dividends. Now, they go up and down, but bottom line, you get paid dividends. So if dividends average 2% over the long term, and you're getting 4% from inflation, then stocks should go up 6% in real terms if you got this 10.5% rate of return. And that's actually what they've done. And so, but not every year. So some years you get less than that, some years you get more than that. And that's that human behavior piece, right? The collective euphoria or depression that people have. And right now people are back to euphoria because it's, well, and you know what? I'm gonna correct myself. It's not euphoria because it's they're not paying attention enough to have euphoria or fear because they're not pulling the trigger. It's the passive fund pulling the trigger, right? It's not the average retail person who's saying, I'm going to buy Netflix at 40 times. The average person has no idea that Netflix trades at 40 times earnings.
Yeah.
No idea. Average person has no idea. My little brother, who just, sent me a note yesterday about NVIDIA. Is this run real? Dude, NVIDIA is a very good company, incredibly good company. Is it worth 10 times revenue? Math says no, but everyone wants to own it because they hear about AI. So, but again, I'm not sure it is maybe with NVIDIA, there are a few people like my little brother who are speculating. So maybe, but for Apple, people aren't buying Apple because they think it's going to go up. It's because it's 7% of the index. And every time money goes in an index, it has to buy 7% of Apple.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. Yeah. It's so difficult to sort of predict, and Mike Green's done a great job of highlighting the market dynamics of passive versus active. I don't know. This is one of those things where I understand the distortions. I understand the argument.
Right.
But also I kind of do like having access to just cheap. It's people view the stock market right now as a savings vehicle. I don't know how sustainable that is in the long term. Maybe it is, maybe it isn't. What I do think, I often kind of hear people talk about, oh, well, like Tesla's got to bust, right? Like Tesla, there's still these speculative things going on, but that's not really what gets you in trouble. Usually the thing that causes panic is not when Tesla blows up, because everyone kind of expects it to blow up or is like, this isn't realistic. It's when some storied firm XYZ, maybe it's a bank, maybe it's a BlackRock type fund, they were levered, maybe they've got a large margin loan, large loan that's margined by Tesla, and then they get in trouble. But it's the things that, it's like that old, what's its face quote, where it's not what you don't know that gets you into trouble, it's what you think you know that just ain't so.
Oh,
and
yeah,
I'm sure there's going to be some of that. One of the areas that I never hear people talking about this, and probably because there has to be a catalyst, and I'm sure this will be wrong or not be proven out for a number of years, but one area that to me just feels like it is ripe for this to happen is private equity. Because for as long as private equity's been a money machine. Anything that's been a money machine for a while, people look at as invincible, sort of impregnable. But I don't know, maybe I'm over extrapolating from what's happened, at least in our industry for the last 2 years. I used to look at that too. I'd say these guys are printing money, blah, blah, blah. Printing money leads to lack of discipline is what it leads to. It leads to a feeling of invincibility. And these guys have why has private equity been a bonanza for so long? Because interest rates have been a one-way street down. And I've asked this question to people, well, now interest rates are back up. Does that impact private equity? And the answer that I've got is no, it's actually somehow good for our business too. And that just doesn't make intuitive sense to me. If it was good on the way down, it's got to be bad on the way up. The cost of financing has gone up. So what happened to your returns? And I don't know.
No, look, the instincts they're 100% right. And the data corroborates your thought pattern, right?
Yeah.
When lots of money gets raised and flows into a sector, private equity, venture capital, growth equity, the returns for that vintage are low. Well, when does the most capital flow into one of these areas? After a period of poor returns or a period of good returns? Period of good returns.
Good returns.
Right? Of course. Human beings do two things really, really well. They buy what they wish they would have bought spectacularly. I mean, the data that's the most damning for all of us as, active investors, is, for 20 years, I said stocks make that 10 and a half, bonds make 6. And, so the average investor should have just done a 60-40 and done somewhere in the middle, right? 7.5%, 8%. The average investor made 2.9. What? How? All you had to do is pick one or the other or a mix.
I know. Yeah.
But they didn't. And I was talking to Bill Miller. So, Bill and
Oh yeah.
Bill the fourth are down here. Bill Miller's a big Bitcoin believer and early adopter. And, I thought
You
I was
should
the
do one of
old
these interviews
guy.
with us.
Pardon?
You should do one of these interviews with us. I would love to chat
Oh
with
my
him.
God. Okay. I might be able to make that happen. But
Yeah.
he's just a legend, right? I mean, I
Yes.
talk
Yeah.
about him all the time. And, my favorite story is right there, the Amazon thing about how volatile it is and when was run time to sell, never, but who actually bought it on the IPO and held it for the 26 years. So it was 26th anniversary last week. And we were talking about this, and there are 5 people in the world that, and it's probably more than 5, but it's Jeff, his mom, his dad, his ex-wife, who got half of his, and Bill. And Bill's cost of Amazon was 7 cents, split adjusted, 7 cents.
Yeah.
And he's never sold a share. And he is the second largest individual owner of Amazon. Why? Because he bought it and he never sold it. And he's kind of doing the same thing in Bitcoin now. But the thing that was funny about this, we were talking about, is it led to this conversation of, well, that corroborates the fact that, the best performing accounts at Fidelity are the deceased accounts or abandoned accounts. They outperform everybody else by far. And it's because they don't do the stupid stuff that human beings do. And so we're in this time where we've got all these decisions that we have to make. And the real decision in some cases might be, don't just do something, sit there. So that is a challenge for most of us.
Yeah. It's tough, right? It's easier said than done. Sometimes hurry up and wait is the most frustrating thing that you can be told. And just on that little prediction on private equity, I'm not saying that's going to happen now. I'll just raise my hand and say I've got a little bit of a bias here. I've started to see the world through this angle. I got sent a meme a little while ago that was like, do you ever have something that you used to really love, but now is shit? Well, you have private equity to thank for that. And they're very good. They do this thing where they see a really great asset that maybe a local entrepreneur has done. Maybe there's a little bit of economic surplus. Is that dumb? Maybe that's being a good business owner because you have a long-term mind for it. Private equity is very good at coming in and extracting that value that exists between having a good experience and what people are absolutely willing to pay for. They borrow leverage to close that gap. And that is what...
No, that's exactly it. But here's the thing. It's over in the sense of, and we went from 8,000 listed companies to 4,000 listed companies. Well, what happened? They get taken over. Well, why did they get taken over? Why did they go private? Well, because the boomers, right, came back from the war and they created these businesses. Right? They started businesses, car wash businesses and hairdresser businesses and travel businesses, just all these businesses. I mean, tons of businesses. And now those people are in their 70s and they want to sell. Well, who's the natural buyer? Private equity with, a big portfolio and network and all, and free money, leverage, free money. And so they quietly chipped away at all these public companies and took them private and merged and did bolt-ons and acquisitions and there's been all this activity. You don't get to do that again, right? These guys at 75 didn't go start another business. They're not the serial entrepreneurs, right? They did their thing, and that's not replicable again. So, we did this one. There's this little thing called 5-minute oil change. Literally, that's the name of the company. And the dad had it, and they had 2 daughters, and the daughters didn't want the company. They're like, Dad, we want cash. So he sold it to private equity, and we bought it and with this private equity firm, and then we sold it to another private equity firm at the height of the free money and made a bunch of money. But is that big private equity firm that paid 16 times EBITDA actually going to flip it to somebody for 20 times EBITDA? Nope. I
Yeah.
call BS on that. They're just not.
Yeah.
And now, the one thing they could do, which I will say is possible for a few of the firms, do they have enough operating expertise to improve the business beyond what that original founder's vision? Like his vision was, I want it to be a nice experience, and because women are the ones that get their oil changed, and so we catered to the women, and it really worked. Can this big private equity firm come in and say, oh, we're going to strip out this cost, we're going to strip out that, and we're going to do a bolt-on? Maybe. But even that window of opportunity or set of opportunities dwindles because there's only so, like HVAC was really hot. Everybody's buying HVAC companies because there's going to be this big building boom. Okay, but once everybody owns all the HVAC companies, you can't do it again. So we'll see. But history tells us there's an inverse correlation between how much capital flows in and what the vintage looks like. And I think the vintage from 2 years ago is not going to be a very good one for venture capital or buyouts. And the vintage right now, if you put new capital, not necessarily just pitching my new fund in venture, but if you put new capital into this vintage, venture in particular, I think is going to be a spectacular vintage. Buyouts, tougher, but I still think will be better than 2 years ago, particularly in the small market, the smaller market, not the large market, because there's too much leverage in that space.
Yeah, one day maybe we can do a whole the reason I was, by the way, they're just like anything else, right? There are great private equity funds who are really geared at like it's a necessary thing too, right? At some point, like the venture kind of peters out, you need a new source of capital with a different return profile to come in. At some point, it's appropriate to put debt on a company. All that aside, there are great private equity firms that have created value for investors and customers and companies alike. So don't want to paint with a broad brush here. It's just I was sort of looking for this area that I got looking for an area where it's been really good for really long. The money's been pouring in, and the incentives. We could do a whole episode, I'm sure, Mark, on just how price discovery happens in private versus public markets, because it's a very different structure, right, for how that all works. And in some cases, it works super well. In some cases, you probably have a little bit of an incentive to, make things go up in a sense too. So that's, I just love to, get in the weeds how that all works.
I mean, if you got one private equity firm selling to another private equity firm so he can get a multiple bump so he can collect his incentive fee, and then they do a quid pro quo the other way.
That's exactly what I was going to say. This is okay. So just I have friends.
Well, Michael, that would never happen. People are far too scrupulous to ever happen.
So Mark, that
probably happens.
To paint a picture in the audience, imagine an example here where you're a private equity fund, you invested in this company or majority owner, and it's got this big valuation, and you want that valuation to go up. Maybe you convince a buddy of yours, invest $15 million, take a small piece at this higher valuation. Equity gets priced on the margin, right? So
on the margin
value goes up. Nice. But then also, hey, your buddy is a private equity firm, and he or she has an investment as well. Well, maybe you give a little $15 million investment there, set the marginal price up. At the end of the day, the dollar amount is the same. You haven't made or lost any money, but the valuations of both of our companies are higher. Yay for us. You know what I mean, I just can't imagine the incentive to do that is so strong.
You are so cynical.
I just can't imagine that hasn't been done.
You sound like me. You're supposed to be the young, optimistic. I mean,
I'm a responder. I'm a believer in incentives. I think people generally do the incentive that is laid out for them.
100%.
And speaking of that, I've got one big story that I'd love to get your thoughts on. This is something that I don't have any insight on, but I sort of am developing an opinion on it. So Tether announced that they were going to be buying Bitcoin. with some percentage of their,
Yeah.
it's, this is not, this is separate from, it's 15% of their net realized operating profits. So it's not, the reserve. The idea is still to do one-to-one backing in terms of their sort of short-term bond portfolio and securities holdings, or cash equivalents, I guess is what you'd call it, and the tether that's outstanding. So this isn't a balance sheet thing. They're not
Nope.
like petering in, but what they are doing is reinvesting 15% of their net operating profit
Net operating
into
profit.
Bitcoin, and they're also doing gold, which is sort of interesting as well. What do you think about this?
Yeah. Uh, and the reason I'm not, just answering immediately is I've been thinking about it, right? I mean, news came out a couple of days ago, and I've been thinking about it, and I didn't react negatively as I would have if they had said, we're going to do this with the asset, like Terra and Luna and all that nonsense, and make a algorithmic stablecoin again. Oh my God, oxymoron of oxymorons. So I
Again,
didn't have a negative reaction like that because they were clear that this is our money, right? It's our treasury,
oh,
and I I'm not bold enough to do it. So maybe, because we have a little tiny treasury at Morgan Creek, and we make some money. And um, I've talked to the guys over the years. Should we do what Michael Saylor's doing, and should we hold it in Bitcoin? And I just haven't been bold enough to do it. So I think it is a good idea. I like the fact of doing a little bit of gold, a little bit of Bitcoin, physical gold, digital gold. Um, if the logic is, hey, we accumulate cash by running a business, and that cash is being devalued every day that we hold it, then we should move it into a cash alternative, a better store of value. History tells us in periods of devaluation of currency, gold works. Right? Lots of history, thousands of years. We don't have as much history with Bitcoin, but the data over the whole period, incontrovertible. It's been an amazing store of value versus the dollar, right? Because we price it in dollars, right? One Bitcoin is one Bitcoin, but one Bitcoin priced in dollars has migrated up with lots of volatility. And I have my Embrace Volatility t-shirt over there. I was thinking about wearing it today, and I decided to go just with a polo shirt. Um, but that volatility is the thing, right? If you need that money, like as working capital to fund a new business, or hire some people, if you happen to have that 64% drawdown while you're holding it, that kind of sucks. If you have 100% run up, then you get to do more stuff. So if it's a long answer to say, as a small piece of your long-term treasury, totally for it. And I think a lot of companies should consider it. Um, and if you look at the success, albeit volatility, of MicroStrategy, I mean, he's made money for his corporation and for his shareholders by converting a depreciating asset, a devaluing asset, cash, into an appreciating asset, Bitcoin. So
yeah. I have some thoughts about this. I have some thoughts, and I look. Do I think buying Bitcoin here and putting it out part of your treasury is like a bad investment? No, I probably think this is going to play out for them. Same thing with gold, but that's my personal investing bias.
yeah,
I have always not loved this trend of putting Bitcoin on your balance sheet. I just think that's not your job as a corporation. You're not supposed to be taking directional bets on. You and I are, we're in the Bitcoin, we're bought into this and view it as, relatively safe, but come on. The majority of the world doesn't view it like that. Like, let's be realistic here for a second. There's
Mhm.
risks. I just don't think that's what you're supposed to do as a company treasury. So I never really loved that. The other thing that I am just starting to get worried about, look, 2022 is in the rearview mirror, but we saw what happened when there isn't transparency. Instead of Tether buying Bitcoin, I would love it if you could get audited by Big Four. You know, the recent attestation report, look, it's a step in the right direction. It's from BDO, which is basically number 5. It's from the Italian branch.
Right.
I don't know if that means anything, but like, I say this as a proud
Wasn't
Italian.
one of the main
So
guys Italian? I mean,
I don't. Oh yeah, Paolo. I guess. Yeah. Maybe he is. But come on. At this point, I just don't think. And what worries me a little bit, I gotta just, I guess, get this on the record. And look, I'll recant it if I'm wrong here. I just don't like how opaque Tether is. I'm not a fan. I
No.
don't see any reason why they can't be more transparent, get audited by a Big Four accounting firm. And guys, if there's a reason, come out and say why. But I just think it's $82 billion for market cap. Something rubs me the wrong way. I got to be honest with you. Just pattern matching. I don't like it when people come out and buy Bitcoin for what I view as the wrong reasons, which is like try to get people on your side or some sort of optics about it. Something doesn't, I just don't like it.
I actually agree with you. I agree with you that they are probably doing it more for PR than a belief. I'll agree with you on that. The place I will disagree, although I'm not bold enough, I'm going to say this, but yet I'm not doing it. I will disagree with, and this is a big if, right? If we, whoever the we is collectively, we believe what we say, so I have to put myself in this camp, that one Bitcoin is one Bitcoin, and that it is a standard of value that we believe is the better form of money being gold, right? Then it actually is incredibly logical and actually probably a fiduciary mandate for an owner of capital, particularly when that has shareholders. If it's private capital, you can do whatever the hell you want. But if you have shareholders, are you being a good fiduciary if you leave it in a devaluing asset, a currency of some jurisdiction, right? Imagine being a treasurer in a Venezuelan company and you left it in bolivars. You're a freaking idiot. Or in pesos in Argentina. You're a freaking idiot. Now, what do? They dollarize. Okay, dollar better. Bitcoin better relative to bolivar or pesos. So I hear you that the volatility part, but the volatility is the perception and the disagreement of the market participants of the value of the network. The ultimate value is fixed. And look, I'm talking the talk and I haven't walked the walk. So I guess I got to go home this weekend and put in the order to put some on the treasury, because when I say it out loud, I can't argue against it, because I do believe that one Bitcoin is one Bitcoin. And that when I look at that relative to the other assets in which jurisdiction I live, it has accreted value.
Yeah. All right. So I have a number of thoughts here, which is I believe so personally, yeah. Personally, I'm basically my entire net worth is in crypto. So personally, I'm okay taking that risk. Company, I think about things differently. I want to minimize the surface area of risk that I'm taking. On a company basis, Blockworks, I want to minimize our risk taking to trying to win in the sectors that we compete, and I don't want to compete against that. So then it's like, okay, I'm looking at the treasury, my liability should match my assets, right? So even if, right, there is some sort of devaluation event, like it's in dollars, right? So, you're even if your assets get devalued, so do your liabilities as well. So they kind of happen in tandem. The other thing that is really starting to impact probably the most influential video I've listened to in the last year, because I've just ruminated on a lot. Go check out, link it up here. Sir Paul Tucker, my colleague Jack Farley, did an interview with this ex-central banker, And hearing an ex-central banker talk about it was fascinating
Mhm.
because in their mind, in this person's mind, which I assume is indicative of how the general apparatus thinks, there are just different kinds of money. And bonds and dollars are kind of different types of money. And there's actually more demand for the bond type of money.
Yeah.
And when you think about it like that, and I'm starting to, this is now my mental framework for how I think about staked ETH as well. Those charts that you've seen of the dollar getting devalued, not if you hold bonds, not if you held this other type of money that was interest-bearing money. And that's what you should be holding your assets in as a corporate treasurer. So you don't have as much de-risk. So when I put it all together, look, I wouldn't blame you. I mean,
But Michael, that's what the
but
banks did. That's what
yeah,
the banks did, right? And
yeah,
then interest rates went up. And the problem is, you said it, it's the asset liability match or mismatch.
yeah,
If you need that money in your treasury to pay people every week, you can't afford volatility,
yeah,
right? Because you need the right amount of capital. And so, but what we are accepting then is that subtle, constant devaluation where the purchasing power is eroding, but we're in it together, right? We're in it together. The employees and the company are in it together. But if you don't need it to pay employees every week, and you don't need it to pay your lease, let's say you've only paid your lease once a year and you don't need it, for a year, yeah, I could take a little more volatility. And here's the interesting thing. If we just think about from the start 14 years ago to today, the value of Bitcoin has risen, right? Just has, right? It's higher today than it was 14 years ago, 13 years ago, 12 years ago, 11 years ago. Unfortunately, there's a point where I can say, no, but it's down from that point. Like from a week ago, it's down, or a month ago, it's down. But over a long period of time, it's accreted value. Why? Because the dollar got worse. Not because Bitcoin got better. One Bitcoin is one Bitcoin. But the Bitcoin priced in dollars went up. Part of that was supply and
yeah.
demand. Part of it. So we could talk all day about this and
But it's it's a very
well, it's
interesting
a very
subject to
interesting
me.
conversation. It's a very
Yeah.
interesting conversation.
For me, it just comes back down to, and I'm not saying, by the way, like Blockworks for, a period of time, we will accept sort of major forms of crypto. We do have, I'm not saying that we don't even hold any on our balance sheet. I would just want to
Yeah.
minimize it and not, it's just about minimizing surface area of risk that we're taking. That's the point that I was trying to make. And
And it's a perfect, it's a great point. And that's why I say it's the asset liability matching,
yeah,
right? If Tether's saying we're so profitable that we now have accumulated this asset and we're going to hold this asset forever
yeah,
because we're doing this forever. Yeah, the asset that I feel best about relative to currencies around the world, and it's not just dollars, but yen and euros, and is Bitcoin. We believe in the new
yeah,
money. If you believe that, and it is that bottom part of it's the bottom part of the Coke can, which is a bad analogy because no one else to drink that. But at the tippy top of the bucket, you need the most liquid, most secure, and the risk you're willing to take is risk of devaluation for certainty of NAV.
yeah.
Right?
That's a good way of putting it. Yeah,
Because risk can't be eliminated; it just changes form. Everything we do has a risk. So I don't want any NAV risk. I can't afford NAV risk because I have to pay my employees a fixed agreed upon amount, unless they agreed to be paid in Bitcoin, right? The mayor down here, right, in Miami gets paid partly in Bitcoin. So whatever the price is, that's what he's getting, but that's what he agreed to. He didn't agree to a certain number of dollars. So then you'd have to adjust the number of Bitcoin based on the dollar price. Then the second layer of liquidity, you might say, bonds are going to be okay for me because the risk of a big move in bonds isn't very high, particularly over a long period of time. But unfortunately, that's what the banks did. Now, they were forced. They were coerced, right? They were forced to buy the bonds, to borrow from the Fed, buy the bonds, do the arbitrage. And then the Fed raised rates on them and blew up their balance sheets. So, but you're right, over a long period of time, that bond money, that moneyness of bonds is superior to the moneyness of cash. But then equities, over a long enough period, you could say the same thing, right? But if
Yeah,
the equity is going to accrete value because of dividends and the pass-through of inflation, then there is a moneyness to that. But again, there's higher volatility. So you could go a year or 2 years or 5 years. You probably can't go 10 years losing money. Well, I guess it's happened 10 years. There's been a 10-year period where you've lost money, but you can't go a 30-year period. You can't go a 30-year period. There's no 30-year period where you didn't make moneyness, positive moneyness of equities.
I know. Yeah, it's a tough one. I guess I got to think about it a little bit more, but I know we're drawing near the end of our time here. So
Yep.
okay, last thing to just look. I don't mean to pick on or be mean to Tether, but I do think it is just, I just don't love that an industry that is trying to elicit change through transparency, the number one stablecoin is this colossal opaque black box, and it just doesn't need to be like that. It just doesn't need to be like that. I just think that we should push them to do better. And if you're listening to this, I would love to help. I don't know what I can do to help, but I
Yeah,
just
look,
don't
I'm with
like.
you. Look, do better is a pretty good motto for life, right? Strive to do better. And I think your point is well made. We are in an industry that is struggling to gain adoption and trust.
Right.
Okay. How do you win trust? Transparency, authenticity, consistency, discipline. Is Tether meeting the standard of do better on those 4 criteria? Not giving him an A on all those. I'm not.
Yep.
Okay. Not giving him an A. I'm not giving him an F, but I'm not giving him an A. So do better is a good mantra.
I agree.
and we all need to do better. I mean, I need to do better. I mean, that's
it. Yeah, for sure.
Life is about getting better.
Best hour of my week, my friend. And I know you're doing the full Bitcoin Miami day today, so I'd love to just hear how things are. We can reconnect next week and give
next week we'll talk about it.
Debrief.
And look, it's me and 25,000 of my closest friends.
Awesome. All right, Mark. Have fun.
Thanks, man.